Hello, ladies and gentlemen. This is Casey O'Rourke with Fross and Fross Wealth Management, bringing you this week's economic and market update on Monday, July 6th, 2020. Before we get started, please take a moment to view those attached disclosures in the email. Well, before we get started, we hope from our family to yours that you had a wonderful holiday weekend and this message reaches everyone healthy and you're all doing well. Well, folks, we are officially halfway through 2020, and what a year it's been. To say the word unprecedented would both be euphemistic and an understatement, to say the least. However, we certainly hit the mid-year mark with a bang. Despite the holiday shortened trading week, markets rose. The Dow Jones ended the second quarter by marking its best quarter on record since 1987, and jobs data showed a much higher increase than expected. The recovery appeared slow and balanced this week as all that good news broke alongside record highs in confirmed COVID cases and states reversing reopening plans. At Fross and Fross Wealth Management, we thought this was a perfect time to look back and assess where we were, where we're at now, and where are we going. To do that, I'd like to break things down into four distinct topics: the markets, the economy, employment, and risks. Let's do a mid-year checkup and see how healthy we are in each category. The first topic that we're going to talk about is the markets. The data shows that domestic stocks fell 4% the first half of the year, which included a 35% drop in February and a 44% rally in March. Because of that decline, we logged our worst first quarter since 2008, yet market returns in the second quarter of the year were the strongest since 1987. This was the 22nd time that the market was in negative territory at the half in the last 70 years. However, historically, we have seen an average gain of 3% in the second half of those 22 instances. Our perspective from here, stocks may be down, but we are in recovery and don't expect to see drops as severe as the second half as we did in the first half. It was a scary time. In fact, we believe we will see equities continue to rise as the recovery continues. We saw a V-shaped pattern in the markets in the first half of the year, 2020, and we believe we'll see more of a W-shaped pattern in the second half, fueled by a rebound in the economy and corporate earnings, but tempered with additional volatility, of course. Second topic that we will discuss today is the economy. The data tells us that we are in our first recession in a decade, which began with an economic contraction of 5% in the first quarter, representing the sixth largest quarterly decline since 1950. Strong economic data indicates we are at the beginning of a recovery with a rebound in home sales, consumer confidence, and manufacturing activity. This is our 12th recession in 70 years, with each decline lasting less than a year on average. Post-recession GDP rose by about 6% over the next 4 quarters in each case, which shows historical resiliency. So our perspective from here, we are definitely in the beginning stages of a recovery, which will continue to take shape more quickly as the economy reopens and releases stunted consumer demand. And we are looking to see positive GDP in the second half of 2020, but time will tell. As we have said in past updates, we believe this will be a gradual recovery because of the continued unpredictable nature of the virus. We expect to see a moderate paced and sustained recovery as the year progresses. Our next topic that we will be discussing is employment. We went from unemployment being at 3.5% in February up to 14.7% in April as the pandemic caused a global economic shutdown. Last week's jobs revealed that jobs are recovering. We lost 22 million jobs in March and April, but regained 7.5 million in May and June. Unemployment has fallen from 14.7% in April to 11.1% in June. So things are improving, getting better as we would expect. The sectors making notable job gains are leisure, hospitality, and retail, the sectors that were some of the most impacted by this whole shutdown. So from our perspective, we all know that 70% of our GDP comes from consumer spending, and improvement in the labor market is critical to economic recovery. So we see the jump in jobs over the past 2 months as highly encouraging. However, the damage was so great that it will take time to return to anything close to pre-pandemic numbers. We also don't want to rule out the fact that as COVID cases increase, the rate of hiring may slow down again in the second half. Again, time will tell. We expect to see a slow recovery in jobs as the global economy slowly navigates the pandemic and the business landscape in the new normal. And finally, our last topic is going to be risks. The data tells us that risks to both the markets and the economy lie completely in the healthcare crisis we are currently experiencing. Concerns like the US-China trade war, geopolitical issues, the global growth slowdown, and US political uncertainties have been muted by the pandemic but remain on the back burner. There's also issues in the crude oil market. Tightening credit and global slowdown concerns have been added to the pressures that pandemic market volatility and economic collapses have brought on our economy. Our perspective of that is, we believe that the markets will be focused on economic reopening and headline sensitivity in the near term. We also expect other risks to raise their heads, like election, liquidity, and policy uncertainty. At Fross and Fross Wealth Management, we continue to believe that both economic data and market behavior support a gradual yet sustainable recovery. We know that much remains uncertain right now with no real end in sight. While we all must accept that, the team is always here for our client family and look forward to helping you navigate the near term as well as the long term. Please reach out to us with any questions or concerns, and we look forward to seeing you soon. Hope everyone stays safe out there and healthy.